UK house prices have slipped further than expected according to the nationwide house price index for June. With the UK dipping back into a recession at the start of the year, it appears the housing market has borne the brunt of this slump. Joining me on the phone now is Nationwide's chief economist, Robert Gardner. Hi, Robert. If we look at the year-on-year data firstly, house prices are now 1.5% lower than 1 year ago. While you've noted in the report that this slightly weaker trend was unsurprising, this is twice the 0.7% decline that had been forecast. What changed?
I think part of it is simply a reflection of the broader economic backdrop being very challenging at the moment. We know the UK economy went back into recession in the first quarter of the year, and there have been few signs of a strong rebound in the second quarter, so that's probably part of the story. I think part of the weakness is also probably relating to the ending of the stamp duty holiday in March. Obviously what that led to was a lot of first-time buyers bringing forward their purchases to the first couple of months of the year. That's now taken away from demand, if you like, at the moment, and probably leading to a bit of downward pressure on prices. So I think those factors probably explain most of the weakness, and the economic backdrop being very challenging is probably, one of the main drivers as well.
You mentioned there first-time buyers. Could this drop in prices not encourage more people to buy who were previously priced out of the market, particularly if we take into consideration that the house price to earnings ratio has dropped by approximately a quarter since 2007?
Yes, it's certainly the case that affordability has improved relative to the situation before the financial crisis. If you look at the house price to earnings ratio, it has moved well off its all-time sort of highs. Nevertheless, it's also true to say that the house price to earnings ratio is still well above its long-term averages. And if you look at things like typical mortgage payments compared to average earnings, they're round about long-term average levels. But at the same time, that's because interest rates are at 300-year lows, and householders are going to be forward-looking. They're going to realise that's not going to be around forever, and recognise that even modest increases in interest rates would lead to affordability, in terms of how much of your take-home pay is taken up with mortgage payments would rise further out. So I think affordability is still a little stretched on some metrics, but obviously these modest house prices we've seen will help ease the situation a little.
With the price of a typical house falling by 0.6% in June and the BBA confirming yesterday that lenders granted nearly 6% fewer loans to buy homes in May compared with April, this signifies a lot less money being pushed into the housing market. The stamp duty holiday did provide some stimulus, but what more does the housing market need?
Well, I think some of the impact of the stamp duty holiday, shouldn't be overlooked in terms of the damping effect it's likely to have had in the last couple of months. If we look at what happened in March, you saw a massive jump compared to what we would have expected. So 40% more first-time buyers in that month than otherwise would have been likely to have occurred because of the end of the stamp duty holiday. And the fact that those purchases were brought forward and are not taking place now is likely to be part of the reason why lending's been so depressed in the last couple of months. I think the fact that the Bank of England has now taken measures to try and support the availability and to lower the cost of credit across the economy is also likely to provide some support for lending going forward as well. The fact that lenders now can be sure that they have access to funding at a reasonable cost will help to make sure that supply is available to the wider economy. However, it's also true that the demand for credit is likely to remain subdued so long as the economic backdrop remains difficult. So I think the Bank of England's measures will help, but we need a strong recovery before credit demand really starts to pick up.
And finally, Robert, with this in mind, what are your predictions for the rest of 2012?
In terms of house prices and, to be honest, activity as well, we're looking for things to remain fairly subdued over the next 12 months, so very similar to what we've had over the last 18 months or so. The reason being that the economic outlook is likely to remain pretty difficult, and it's going to continue to dampen the demand for homes, but at the same time there are going to be some factors that will help to support prices. The fact that construction activity remains very weak, the fact that the rate of house building still isn't keeping up with the rate of household formation, that's going to mean prices are unlikely to decline very far because we're not going to get an accumulation of unsold homes on the market. And the fact that the Bank of England has taken these measures to help secure the availability of credit across the economy and lower the cost should also help to support demand for homes, stop it weakening too far.
Robert, thank you very much for your insight. Coming up on Dukascopy TV, we've got the final Targets in Focus interview of the trading week and the all-important week ahead interview. For now though, goodbye.